Hello and welcome to the Global View on this Friday. I'm Andrew Gagan. Good to have you with us here at Ausbiz. Let's take a look at what happened overnight. Another bout of heavy selling on Wall Street with stocks weighed down by uncertainty over US trade policy. The Nasdaq down some 10% from its December closing level, marking a correction. The S&P 500 is down to a 4-month low. Stocks, specifically carmaker General Motors, fell further along with Ford despite an exemption on US tariffs. Tesla fell heavily, with brokerage Baird naming the EV maker as a bearish fresh pick. Chipmaker Marvell plummeted after its results failed to impress investors, with revenue forecasts sparking concerns about spending on AI infrastructure. Other semi makers were lower, although Broadcom finished higher, Nvidia though slipping. And retailer Kroger rose after forecasting annual same-store sales largely above estimates. Well, President Donald Trump has exempted goods from both Canada and Mexico under a North American trade pact for a month from the 25% tariffs that he had imposed earlier this week. This comes after he exempted car makers from the 25% tariffs he imposed on both Canada and Mexico. Meanwhile, in the latest read on the US labour market, weekly jobless claims fell to a seasonally adjusted 221,000, which was below economists' expectations. And the European Central Bank has cut its policy rate by 25 basis points, taking the deposit rate to 2.5%, as widely expected. In its statement, it said monetary policy is becoming meaningfully less restrictive. And German bund yields have risen again after recording their biggest daily rise in more than 25 years in prior sessions, as the government plans a vast spending package. Longer-dated US Treasury yields have risen as investors consider the latest details on Trump's tariffs. The yield on the 10-year up more than a point to 4.28%. The 2-year, though, dipping to 3.97%. And in currencies, the Japanese yen and Swiss franc have advanced as investors turn increasingly risk-averse, which saw the US dollar continue its recent slide. The Aussie at 63.3 US cents. And Bitcoin is trading down at 90,000 US dollars. On the commodities front, prices broadly higher, although oil remains under pressure amid global trade concerns. Brent closing just below $70 a barrel. Copper has continued its recent ascent to be up another 3%, and iron ore is up more than 0.5% to 100 US dollars a tonne. And the gold price easing slightly on profit taking, with the spot price at $2,912 an ounce. Well, let's get across what we're seeing in markets with a particular focus on the US. Dave Sekero, Chief Market Strategist at Morningstar, joining us again. Dave, terrific to catch up with you as we begin the new month of March. Now, interesting to know what's going on with equities at the moment. Significant pullback, certainly seeing, as I mentioned there, with the Nasdaq. What are your observations?
Well, I think first of all, just for a little bit of background, I just have to note, at the beginning of the year in our 2025 U.S. market outlook, we noted that the market was trading at about a 4 to 5% premium to a composite of our fair values. And while sometimes that may not sound like all that much, less than 15% of the time since 2010 had that occurred. So we were starting to get into some pretty rare territory as far as how much the market was starting to get overextended at that point in time. Now, I'd also note too, in our outlook, we did recommend the overweight value and underweight growth. So what we've seen today, and actually throughout the entire year, is value stocks have actually been doing very well. We have seen a big rotation into value stocks. We're trading at an 8% discount at the beginning of the year, whereas growth was trading at a 24% premium at the beginning of the year. In fact, just to put that into context, the last time we saw growth stocks at that much of a premium over our fair values was in early 2021, and that of course was the height of the disruptive tech bubble. So we are seeing the big rotation into value, away from growth. When I incorporate today's downdraft, the Morningstar Growth Index is now down at 6% year to date, whereas the value index is up over 3%. So according to our evaluations, while this has been working, we still think that trade still has further room to run in the US.
In particular, there's a focus on those AI stocks, which have fallen certainly precipitously. But you're saying essentially that was needed.
Yeah, I mean, this painful it is,
Hmm.
to go through, any kind of, market sell-off like what we've seen. I think really the market has kind of needed this, for a little while just to take, some of the air out of those AI stocks. At best, those AI stocks, by mid-January were, fully valued, with a lot of them getting to be pretty overvalued. So at this point, from their highs, a lot of those AI stocks are now down anywhere between, 15 and 20%. There's some of them which are now firmly in correction territory. And even from here, we still think that there's a number of them that still has further to fall. ARM is a one-star rated stock. That's one of the more overvalued stocks, under our coverage. Some of these second derivative plays on AI, like the independent power producers, everyone was buying those up just because they expected a big demand for electricity over time, just as AI chips require multiple times more electricity than traditional chips. So companies like Vistra Energy was one of the most overvalued stocks under our coverage. That one has fallen a lot. We still think that one has further to fall. But I guess the good news is, some of these stocks have now fallen far enough that they're actually starting to finally look attractive again. The one I would highlight there is going to be Taiwan Semiconductor. So that's a 5-star rated stock, which is an indication of being one of the more undervalued stocks under our coverage. And it's trading at slightly over a 30% discount. So now I think this market pullback is giving you an opportunity to move back into names like that one.
So, Dave, you're seeing a trend now as investors look towards moving away from those hardware providers for AI into those utilizing
Yeah.
AI to drive their revenue growth.
Yeah, I think, the DeepSeek scare earlier this year was really that catalyst causing investors really to start undergoing a recalibration and expectations for just how much growth and how long that growth is going to last, among the hardware providers. And in fact, I wouldn't be surprised to see a lot of those hardware providers, continue to sell off here, in the short term. But as we mentioned in our 2025 outlook, we think that this year is really going to be the next step in the evolution of investing in artificial intelligence. And I really think investor focus this year is going to shift towards those companies that can take AI, utilize it within their own products and services, be able to develop, new and novel ways of using AI to start generating additional revenue growth. And then also looking for those companies that can take AI, put it into their own business processes to be able to drive, efficiencies, productivity in order to help expand operating margins over time. And we are starting to see that. I think the easy ones that you can identify doing that are going to be companies like, Microsoft and Alphabet. Those are both 4-star rated stocks trading at 40% and 27% discounts to our fair value. Starting to see some companies like ServiceNow, that's down 27% from its high. It's now trading at a 12% discount to our fair value of 990 per share. And another one to highlight that I think will be a good beneficiary over time of incorporating AI into its business is going to be Salesforce. That one is also down over 20% from its high. It's now trading at a 10% discount to our $315 per share fair value.
Now, Dave, of course, the trigger for this sell-off has been that uncertainty around President Trump's trade policy with a focus on tariffs, of course. What do investors need to consider? How do you navigate this uncertainty?
Yeah. Well, like anything else, I think one of the hardest things in investing is to be able to separate, signal from noise. And I think in this case, you need to separate what President Trump does, versus what he says. And as you mentioned, the situation just remains extremely fluid right now. It's kind of an on again, off again, on again. We'll reduce these tariffs for now, but still keeping the pressure on. So while all this is going on, I think as an investor, and I know our equity analyst team is doing it, you just got to remain focused on the fundamentals and valuations. When I think about the 25% tariffs outstanding on Canada and Mexico right now, I don't expect that these are going to be the tariff levels that remain outstanding over time. So I think until you have specificity on what that final resolution is going to be on the tariff negotiations are with both Canada and Mexico, you really need to keep looking for those stocks trading at big discounts to their intrinsic valuation. And once we have that kind of clarity, then we can adjust our valuations accordingly.
And so, Dave, sector-wise, where are you looking to be overweight and where underweight?
Well, and again, sector-wise, still looking for a lot of those stocks are going to be in more defensive-oriented sectors, especially companies with, an economic moat. That's our kind of Warren Buffett analysis, looking for those companies that have, long-term durable competitive advantages. So really high quality, high dividend value stocks are where I see some of the best plays, in the marketplace today. So companies like Kraft Heinz, I think that's a 5-star rated stock, trades at a 45% discount from our intrinsic valuation. Nice high dividend yield at 5.2%. It's a company we rate with a narrow moat and a medium uncertainty. Verizon, all 4-star rated stock at a 19% discount, 6.3% dividend yield. So, names like that where you can essentially kind of get paid to wait, while they work themselves out over time. High quality brand names like Clorox trading at a 14% discount, 3.25% dividend yield. I think that one looks pretty attractive too.
Dave, always great to get your outlook from Morningstar. Thanks so much for joining us.
Well, thank you.
Let's take a quick look at where we're likely to open. Looking for another negative start. In fact, SPI futures off almost 0.9%. So stay with us. We're going to get right across the open in just a couple of minutes.